Hello student, welcome to the lecture on understanding capital investment and financial decisions, and after this lecture we will be able to learn the following objectives. Understand concept of financial decision, discuss about procurement of funds, describe factors influencing financial decision, explain cost volume profit analysis, discuss break-even analysis. Capital investment (CI) can be seen as a subset of capital budgeting. Capital budgeting refers to both the selection of long-term investment and planning for their financing. Capital investment entails the making, communication, and acceptance of decision about investment in long-term, risky capital assets. Capital investment are funds invested in a firm or enterprise for the purpose of furthering its business objectives. Capital investment may also refer to a firm's acquisition of capital assets or fixed assets such as manufacturing plants and machinery that are expected to be productive over many years. Capital investment encompasses a wide variety of funding options, while funding for capital investment is generally in the form of common or preferred equity issuance. It may also be through straight or convertible debt. Concept of financial decision. Financial decision is an important function which a financial manager must perform. It is important to make a wise decision about when, where, and how should a business acquire funds. The financing decision must consider several factors. Some of these factors include flexibility. Today's financing decision will influence tomorrow's financing decision. If the business expects to raise capital in the future, it cannot maximize its use of debt today. One needs to provide a cushion so one can have flexibility with future financing decision. Risk. Financing with the use of debt will increase risks. There is a limit to how much debt one can use to finance our business. Income. Financing can influence earnings and thus affect return on equity. If one is concerned about returns to equity shareholders, then our financing decision will need to be adjusted. Control. If one have concerns about control over the organization, then one have to consider how financing will change control. Financing decisions are connected to either ownership equity or creditors' debt. Timing. Financing decisions need to be timed to take advantage of the marketplace. Investment decision. One of the most important finance functions is to intelligently allocate capital to long-term assets. This activity is also known as capital budgeting. Following are the two aspects of investment decision: evaluation of new investment in terms of profitability, comparison of cut-off rate against new investment and prevailing investment. Investment decision not only involves allocating capital to long-term assets but also involves decision of using funds which are obtained by selling those assets which become less profitable and less productive. Investment decisions are significant at two levels: for the future operability of the organization making the investment and for the economy of a nation as a whole. Financing decision. The financing decisions are decisions concerned regarding the method that are used to raise funds which would be used for making acquisition. The financing decisions are decisions concerning the liabilities and stockholders' equity side of the firm's balance sheet, such as a decision to issue bonds. There are two fundamental types of financing decision that the finance teams need to make in a business: investment and financing. Investment. An investment decision revolves around spending capital on assets that will yield the highest return for the company over a desired time period. The investment must meet three main criteria. It must maximize the value of the firm, also considering the amount of risk the company is comfortable with. It must be financed appropriately. If there is no investment opportunity that fills, the cash must be returned to shareholder in order to maximize shareholder value. Financing. All functions of a company need to be paid for one way or other. It is up to the finance department to figure out how to pay for them through the process of financing. There are two ways to finance an investment: using a company's own money or by raising money from external funders. There are two ways to raise money from external funders: by taking on debt or selling equity. Taking on debt is the same as taking on loan. Dividend decision. Dividend decision refers to the policy that management formulates in regard to earnings for distribution as dividends among shareholders. Dividend decision determines the division of earnings between payments to shareholders and retained earnings. The dividend decision in corporate finance is a decision made by the directors of a company about the amount and timing of any cash payments made to the company's stockholders. Factors influencing dividend decision. There are certain issues that are taken into account by the directors while making the dividend decision. Free cash flow. The free cash flow theory is one of the prime factors of consideration when a dividend decision is taken. Signaling of information. It has been observed that the increase of the worth of stocks in the share market is directly proportional to the dividend information that is available in the market about the company. Clients of dividends. While taking dividend decision, the directors have to be aware of the needs of the various types of shareholders, as a particular type of distribution of shares may not be suitable for a certain group of shareholders. Form of dividend. Scrip dividend. An unusual type of dividend involving the distribution of promissory notes that calls for some type of payment at a future date. Bond dividend. A type of liability dividend paid in the dividend payer's bonds. Property dividend. A stockholder dividend paid in a form other than cash, scrip, or the firm's own stock. Cash dividend. A dividend paid in cash to a company's shareholders, normally out of its current earnings or accumulated profits. Factors influencing the dividend decision. Liquidity of funds, stability of earnings, financing policy of the firm, dividend policy of competitive firms, past dividend rates, debt obligation, ability to borrow, growth needs of the company, profit rates, legal requirements, policy of control, corporate taxation policy, tax positions of shareholders, effect of trade policy, attitude of the investor group. Liquidity decision. Current assets management, which affects the firm's liquidity, is yet another important finance function in addition to the management of long-term assets. Liquidity decision is concerned with the working capital management or current assets management. Current assets should be managed to save the firm from the illiquidity and insolvency. Liquidity decisions are concerned with satisfying both long and short-term financial commitments. Procurement of funds. Since funds can be obtained from different sources, therefore their procurement is always considered as a complex problem by business concerns. Funds procured from different sources have different characteristics in terms of risk, cost and control. The cost of funds should be at the minimum level. For that, a proper balancing of risk and control factors must be carried out. Some of the sources of funds are equity. The funds raised by the issue of equity shares are the best from the risk point of view for the firm, since there is no question of repayment of equity capital except when the firm is under liquidation. Debentures. Debentures as a source of funds are comparatively cheaper than the shares because of their tax advantage. The interest the company pays on a debenture is free of tax, unlike a dividend payment which is made from the tax profits. Funding from banks. Commercial banks play an important role in funding of the business enterprises. Apart from supporting businesses in their routine activities, they play an important role in meeting the long-term and short-term needs of business enterprise. international funding. With liberalizations and globalizations of business, enterprise has options to raise capital from international markets also. Foreign direct investment (FDI) and foreign institutional investor (FII) are two major routes for raising funds from foreign sources besides ADRs, American Depository Receipts, and GDRs, Global Depository Receipts. Effective utilization of funds. Some of the aspects of funds utilization are utilization for fixed assets. The funds are to be invested in the manner so that the company can produce at its optimum level without endangering its financial solvency. Utilization for working capital. The finance manager must also keep in view the need for adequate working capital. Factors influencing financial decision. The nature of financial decision varies from one firm to the other. Factors which influence the financial decisions are follows. Microeconomic factors. Microeconomic factors are related to the internal conditions of the firm. Important among these conditions are nature and size of the enterprise, level of risk and stability in earnings, liquidity position, asset structure and pattern of ownership, attitude of the management. Macroeconomic factors are the environmental factors that are beyond the control of the firm's management. They relate primarily to the state of the economy. The state of the economy changes from time to time and the financial decision of a firm conform to these change. The state of economy is also denoted by the structure of capital and money markets. Governmental policy. Governmental policy is no less significant influencing corporate financial decision. State intervention or state regulation is found in almost all countries, although its degree varies. The Indian Companies Act 1956 provides certain dividend declaration and payment rules which have to be followed by finance managers. Taxation rules framed by the government also shape corporate decision. Since taxation absorbs a good part of a firm's income, the finance manager normally has to find out how to minimize the tax burden. Cost volume profit analysis. Cost volume profit (CVP) analysis is a managerial accounting technique that is concerned with the effect of sales volume and product cost on operating profit of a business. It deals with how operating profit is affected by changes in variable costs, fixed costs, selling price per unit, and the sales mix of two or more different products. CVP analysis has following assumptions. All costs can be categorized as variable or fixed. Sales price per unit, variable cost per unit, and total fixed costs are constant. All units produced are sold. Where the problem involves a mixed cost, they must be split into their fixed and variable components by a high-low method, scattered plot method, or regression method. CVP analysis formula. The basic formula used in CVP analysis is derived from profit equation Px equal to Vx plus Fc plus profit. In the formula, P is equal to price per unit, V is equal to variable cost per unit, X is equal to total number of units produced and sold, and Fc is equal to total fixed cost. Contribution margin (CM). Contribution margin is equal to the difference between total sales S and total variable costs, or in other words, it is the amount by which sales exceed total variable cost VC. CM is equal to S minus VC. Unit contribution margin, unit CM. Contribution margin can also be calculated per unit, which is called unit contribution margin. It is the excess of sales price per unit P over variable cost per unit V. Unit CM is equal to P minus V. Contribution margin ratio, CM ratio. Contribution margin ratio is calculated by dividing contribution margin by total sales, or unit CM, by price per unit. Assumption in CVP analysis. The basic profit equation relies on a number of simplifying assumptions. Only one product is sold. However, multiple products can be accommodated by using an average sales mix and restating Q, SP and VC in terms of a representative bundle of products. If the equation is applied to a manufacturer, beginning inventory is assumed equal to 0 and production is assumed equal to sales. Relaxing these assumptions requires additional structure on the equation, including specifying an inventory flow assumption and the extent to which the matching principle is honored for manufacturing cost. Fixed costs remain unchanged in total and variable costs remain unchanged per unit over the range of Q under consideration. Break-even analysis. Break-even analysis is a technique widely used by production management and management accountants. It is based on categorizing production costs between those which are variable and those that are fixed. Total variable and fixed costs are compared with sales revenue in order to determine the level of sales volume, sales value or production at which the business makes neither a profit nor a loss. The break-even point. The break-even chart. The break-even chart is a graphical representation of cost at various levels of activity shown on the same chart as the variation of income with the same variation in activity. The point at which neither profit nor loss is made is known as a break-even point. Fixed cost. Fixed costs are those business costs that are not directly related to the level of production or output. Examples of fixed cost: rent and rates, depreciation, research and development, marketing costs, non-revenue related, administration cost. Variable cost. Variable costs are those costs which vary differently with the level of output. They represent payment output related inputs such as raw materials, direct labor, fuel, and revenue related costs such as commission. A distinction is often made between direct variable costs and indirect variable costs. Direct variable costs are those which can be directly attributable to the production of a particular product or service and allocated to a particular cost center. Raw materials and the wages, those working on the production line, are good examples. Indirect variable costs cannot be directly attributable to production, but they do vary with output. These include depreciation, maintenance, and certain labor costs. Summary. Let us now summarize what we have learned in this lesson. Capital investment entails the making, communication, and acceptance of decision about investment in long-term risky capital assets. Financial decision will affect the entire business operation of the concern. One of the most important long-term decisions for any business relates to investment.